the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Oli's picture that says looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory data.
EIA printed a build of 1.4 million barrels on crude oil, Cushing, Oklahoma building 213,000 barrels. Not a very big build, but hey, at least it's a build, and that's better than what we've seen recently. Gasoline drawing down only 156,000 barrels, so not a big deal. The only significant print on the board was the drawdown on distillates at 1.7 million barrels. U.S. production holding unchanged at 13.2 million barrels. The overall theme this week, up until late morning on Wednesday, was the market selling off because most traders have decided that the risk of the Israel conflict escalating to the point of affecting oil supply is negligible. Then the news hit the tape that Israel has agreed to delay its ground invasion of Gaza in order to give the United States time to move more missiles into the region to serve as a deterrent to further escalation. To my thinking, this was an obviously escalatory and therefore bullish event, but the market sold off hard on the news, bottoming at 82.08. Now that number is fresh in my mind because it only missed my resting buy limit order at 82.06 by 2 lousy ticks, so I missed my chance to lever up on the move before it predictably reversed. I had actually stepped away from my desk for a few minutes. By the time I came back, the whole thing was over. The big move down and then the retrace back up. From the initial tape bomb to well over $1 down to the low at 82.08, then a full retrace all the way back up to the price where the news first hit the tape took all of 12 minutes. But by the close, the market had rallied more than $3 off its lows to close above both the 55 and 13-day moving averages. Then it briefly retested the 5-day moving average at 85.58 during the overnight session. I want to repeat and stress something I said in the feature interview, which is that both Dr. Anas Al-Haji and Ola Hansen are far more experienced and widely respected experts than I'll ever be, and they both disagree with my very bullish oil market outlook, which is based almost entirely on geopolitical escalation risk, both in the Israel and Ukraine conflicts. That said, this feels to me just like February 2020. Lots of people smarter than me just couldn't see what I thought was obvious. So do I have it right again, or am I just paranoid? Because yes, I definitely admit I'm a very anti-war kind of guy. I am probably more concerned and maybe even more paranoid about these geopolitical escalation risks than most other traders. So I'm going to line up quite a few dominoes to explain what I think could happen and why I think those risks justify a bullish crude oil market view. Clearly, these are not predictions, these are just risks. Let's start with why Israel's commitment to delay their invasion to allow USA more time to move more firepower into the region was strongly bullish, not bearish as the market first interpreted it. The Israeli people just went through something even more horrific than 9/11 was to Americans. Therefore, there's very strong military and public sentiment pressure for the IDF to take retaliatory action against Hamas. Military leaders are almost certainly frustrated by the delay because every minute they wait gives Hamas operatives more time to hide, escape, take hostages, or otherwise make themselves less vulnerable. So there's no way that Israel would ever agree to this delay unless there was some concession offered in return. Now, we can't possibly know what that concession was because it's a military secret. All we can do is speculate and guess as to what might be going on behind closed doors. To my thinking, a distinct possibility is that Israel made a deal with the U.S. Pentagon, effectively saying, okay, look, you want us to delay this invasion, so if we do that for you, what we want in return is a promise that if Iran attacks us, the United States will immediately unleash all of that newly arrived firepower on Iran. Remember that late last week, Senator Lindsey Graham said very directly that if Iran attacked Israel, USA would respond by using military force to, and these are his words, not mine, knock Iran out of the oil business by destroying their oil-producing and refining assets by force. Obviously, it's not in the United States' interest to take what I'm guessing is about 3 million barrels of oil production offline. We don't know the exact number because some of that is gray market and black market transactions. To take that supply offline at a time when the world is already running low on spare production capacity doesn't make any sense, but neither did draining the SPR as a war with a nuclear superpower was starting, and they still did that. We have no way of knowing what deal was struck between the United States and Israel to bring about this delay of the invasion, but we can easily deduce that the United States pledged some sort of additional military support to Israel in the event of escalation, and that's why this was a bullish market event, not a bearish market event. The stated U.S. strategy is that the 2 aircraft carrier battle groups and numerous guided missile destroyers and cruisers headed to the region are going there to serve as deterrents, not to enter a conflict. And as soon as they get there, Iran couldn't possibly dare to try attacking Israel because obviously they would never dare to take on the United States in a military conflict. I'm not sold at all on that logic. I actually think that this so-called deterrence could actually serve an aggravating rather than deterrent effect. But if I'm wrong and Iran backs down completely, then the market will trade lower for now, and I'll have been proven wrong on this particular call, at least in the short run. In the event that Iran strikes Israel in reaction to the ground invasion, which we know now is certain to happen, albeit after a delay, Israel, and probably the United States as well, will respond very aggressively and cause extreme damage to Iran, possibly taking all Iranian oil production offline. Now, if that happens and the U.S. and/or Israel do attack Iran, Russia is likely to come to Iran's defense, and that could lead to direct hot warfare between the United States and Russia. If that happens, it's likely that it would immediately expand to both fronts, Israel and Ukraine. And in the very worst case, that could lead to a civilization-threatening thermonuclear conflict between the United States and Russia. And by the way, that phrase, civilization-threatening, was borrowed from Elon Musk, who opined this week that we are literally sleepwalking into World War III, and I very much agree with him. I just laid out quite a few dominoes in a row, so obviously these are not hard predictions. I'm just trying to emphasize all of the potential escalation vectors to explain why I'm so much more concerned about the risk of Iran escalation than either Ola Hansen or Dr. Anas Al-Haji are. And to be clear, if the deterrence strategy works and Iran backs down completely and doesn't retaliate for Israel's coming ground invasion of Gaza, then, okay, I was wrong and the oil market is probably all clear, at least from the Israel conflict, at least for now. I'm just a whole lot more skeptical than my more experienced peers are about how likely this strategy of deterrence is to work. I also don't rule out Iran striking Israel preemptively, even before any ground invasion begins. Let's all hope that I have this completely, totally wrong, and Anas and Ola have it right. I won't mind the big trading loss that I'll take as a result if it means that we averted the risk of a nuclear escalation with Russia, which I do think is a very real possibility right now.
So, Eric, on page 2, I just have a chart on crude oil. And, obviously geopolitics, like you're suggesting, is going to be a big factor. But we had a very bullish impulse through August and September. And even before this escalation, we saw prices of crude oil trading up into the mid-90s. Now we're retracing and consolidating that move. The 200-day moving average just lies below $80. And one of the things I speculate is that even if we do have some short-term weakness, my first position is that that support line will hold and it will prove to being a buying opportunity. Obviously, the magnitude of the upside will have a lot to do with whether or not there's escalation in the situation like you were alluding to. But at minimum, I think that there's going to be an asymmetric buying opportunity to fade this back up into the 90s if it did get down toward the $80 area. So we'll keep a close eye on where those little turn points are. Nonetheless, let's move on to the equity markets. What's your position here, Eric?
The chart looks bearish with the 200-day moving average solidly taken out to the downside. But remember, the usual war cycle for equity markets is that the market tanks on the outbreak of a new war as people panic emotionally. Oh my gosh, a new war is breaking out. Sell everything. Then they remember that wars are always inflationary and the government will be spending hand over fist on armaments, and the stock market rallies, usually led by defense stocks. So my best guess from here, if we do see a geopolitical escalation, is that the market would move sharply lower at first and then rally back toward its recent highs after the news of yet another new war has been digested emotionally by the trading community.
All right, I want to get Nick into this conversation. Let's just start off with getting the different levels based on the options markets. Nick, what are you watching here, bud?
Yeah, so right now the spot price on SPX is approximately 41.85. We have a call wall above at 4,300 and a put wall above as well, which broke yesterday at 4,200. The implied move for the November 17th monthly OPEX is plus minus 160 points. So the upper range would be 43.45 approximately, and the lower range would be 40.25, which is just above very key support of 4,000. Now we have resistance above now at 4,200 and support below at 41.50, 4,100, then that very key level of 4,000. I'm pretty surprised that we smashed so far below 4,200 already. Yesterday, I thought we'd pin somewhere between 4,200 and 4,250 or so. And now, looking at 41.85 area, it's possible we bleed out back to 41.50. But I do expect a short-term bounce back toward 42.50 before more downside. Again, seeing Meta earnings and Google earnings come out strong, and watching both names fall heavily, that to me is a very bearish signal overall.
I couldn't agree more. It's interesting that you say that. First of all, on page 4, I have the S&P 500 chart, and I just wanted to put that 200-day moving average. And the most important thing to highlight is that if you go back to the start of the 2022 bear market, once that 200-day moving average was violated, it began a one-year period where the market was essentially in bear market mode. And we now have officially broken below that 200-day moving average. Now, that in itself should not be a trigger point for a tactical trade, but it is more in the bigger picture, this idea that this market isn't holding key supports, but rather deteriorating through key levels. Now, we have an incredibly oversold market. When you look at the broad market, so when you look at where the Russell 2000 is, where the S&P 500 equal weight index is, and what's held the S&P 500 and the NASDAQ up was those Magnificent Seven stocks. And just like you were saying with what's happened on those earnings, you have a scenario where, if the Mag 7 start just some sort of a distribution cycle and investors start to rotate out of them maybe into some of these incredibly beaten down value names that are offering extraordinary yields, if that kind of a rotation happens, these are such a huge weighting on these market cap weighted indices that maybe it is going to spur a little bit further distribution in this. And so that's one of the key things to watch. I think that while this sell-off up till now has already reached some very oversold levels, and even to me, the targets I use are all suggesting 4,100 as a logical place to look for a swing low. But sometimes when you have these spikes in volatility and participants kind of get spooked out, it creates an overshoot. And one of the questions I'm asking myself here is, even though this might be, the seventh, eighth inning of this decline, is there going to be some serious volatility in the establishment of the bottom with some, a big kind of little washout move that really kind of knocks out some of these traders that have too tight of a stop loss? It's going to be really interesting. So on page 5, Nick, you have that chart on the NASDAQ. Obviously this is where the Mag 7 live. What's you watching here?
So spot price right now on the Qs is 347 approximately. We have a call wall above at 380, and we have a put wall below at 345. The implied move for the November 17th OPEX is plus minus 17 points. So the upper range would be 364 or so, and the lower range would be 330 or so. Key resistance right now is above at 355, then 360. And key support is just below at 340, then 330. And as you said previously, I do think we do get a bounce at some point because we are pretty heavily overextended to the downside. We're now down about almost 5% in the last week or so, which is a pretty substantial drop, for any market, right? And the thing that worries me again is seeing Meta and Google both report well and then decline. Google's down over almost 10% yesterday, and Meta, as we speak, is down about 5%. The one that actually held up pretty well was Microsoft, and they had a strong report. They were still positive yesterday, but even so, it was a very muted move overall to the upside. So if we start seeing these names, as you said, fall down, like Google, Meta, Nvidia as well has been faltering too. So those are 3 out of 7 names that are already faltering. Apple's not looking very strong either, and Amazon reports tonight. So we'll need to see what Amazon does. But overall, it's hard to be bullish longer term. I do think we do get some short-term pops, and I will be playing those myself, but I won't be positioning for like long-term bull side.
Well, it's interesting. I don't have the chart in the chart deck, but we were suggesting NVIDIA. And what's interesting about that is we're going to certainly have to wait deeper into November to get its earnings. But the price action has been very toppy ever since reaching back in June, July, this kind of 400 to 450 level. It's really been one big topping formation. And as a technician, it's very easy to call that like a head and shoulders topping formation. And if that became the pattern that's there, that $400 neckline where all of the lows that have been established in the summer lie, if the 400 level is given out with a breakdown, especially if it's accompanied by the rest, then I think that is going to spur some feedback selling that could be what drives a short-term breakdown in the NASDAQ. Boy, are we at an interesting moment. It'll be interesting to see whether or not these breaks happen this week and whether that spills into the S&P. Nick, though, on page 6, what I find fascinating is when we look at the volatility index, you would think in these types of market conditions that we would have seen already a spike north of 25 on the VIX. And here we are at 21, which is certainly substantially off of the 13 handle we were at during the summer. But the 21 level was the levels we were consolidating at the bottom end of the range throughout almost all of 2022. And, in my mind, I'm almost asking the question, do we need to first see some sort of a market washout where the VIX is blowing through the upper boundary of 25 towards 30 in order to really bang out a swing low? It's certainly interesting that the VIX has not been as responsive as one would have thought in the light of the current conditions. What do you make of the VIX?
So right now with the VIX at around 21, we should expect about 1.3% moves each day. What I think of it right now is that we're seeing a lot more selling in broad markets, which versus hedging for larger portfolios. So this is why I'm kind of inclined to think that we're seeing a more muted move to the downside. If you look at the S&P chart over the last couple of weeks, it's been a very gradual decline, even though we've fallen a fair bit in the last couple of weeks, from a high of 43.90 We trickled down to 43.50, then 4300, then we popped back up to 43.40, then it fell back down to 42.80 or so. It's been a very, very gradual decline. It hasn't been a very fearful decline like we saw in March of 2020, for example, right? So I'm not seeing a lot of hedging activity taking place. It's more so gradual selling, which means gradual decline to the downside and a lack of a spike in the VIX. Now moving on to page 7, we have the US dollar index. Eric, what are your thoughts here?
We're still in the consolidation range between 105 and 107, on watch for an upside breakout, which would probably be coincident with a geopolitical escalation.
Eric, I agree with that the geopolitical escalation is a factor, but the fact that we are seeing all of the central banks releasing their monetary policy statements within a week is, I think, going to play a big role as well. Bank of Canada just came out. We'll have the ECB just after we're recording this, and we're going to then have Bank of Japan, Bank of England, and the FOMC next week. And I think that that's going to play a role in determining whether or not the dollar at this point is technically looking like a flagging formation, which typically is a midpoint of a continuation pattern. And if in this week period where we're in risk off, it typically is a play where the US dollar remains a safe haven asset. So a breakout above 107, I think, is the path of least resistance. And that certainly opens the window for a move to 109 to 110. It'll be really interesting to see whether that continuation pattern plays out.
Moving on to page 8, we have the gold futures charts. What are your thoughts here, guys?
After the massive move up in the last 2 weeks, gold's slow stochastics are high and wobbly, signaling the risk of a pullback to retrace at least some of this gigantic one-way elevator ride straight up. But geopolitical risk will likely keep a bid under gold, at least for now. If the deterrent strategy works and there's no military conflict with Iran, that would likely bring a downside correction.
It was an interesting observation that Oli made about the fact that this was driven by a short squeeze, and that really does fit the characteristic, because the speed and velocity of gold moving to the upside shows those characteristics. The bigger question is, could we see a scenario where the typical intermarket relationship of the dollar rising being a headwind for gold decouples, and whether gold can actually rally in that environment? Now, what I would really be looking for here is when gold inevitably consolidates, that it stays well above 1900 and that works its way for a breakout above 2000. If that's the case, I agree with Oli's view that the upside would certainly be towards 22 to 2300 on the upside of a targeted move. I think the easiest thing for our listeners to do is simply watch the 2000 pivot. If gold can stay first of all, above 1900 during consolidations and then makes the break above 2000, I really think that does open the window for that advance. And I think even though the previous highs are closer to 2100, I really think that the next test towards those highs will be broken on the upside. So it'll be interesting to see whether gold can finish that move. Moving on, I wanted to just touch on a few other charts. I have on page 9 the 2-year government bond in the U.S. And what's interesting here is obviously we've seen bond carnage, but the 2-year yield is very much influenced by Fed policy. And we've really seen that the selling has subsided in the 2-year bond as it's clear that the Fed is moving towards, if not have already started, at least a pivot toward a pause. And then that really asks the question, are we witnessing the bottoms being formed on these 2-year bonds? And is it an opportunity to set up for what will maybe inevitably down the road be an easing cycle that will relatively impact these bonds with a bullish advance? This is certainly on my mind. Obviously, it's very premature. There's no technical reason to see that the 2-year is breaking out or something like this, but certainly it's establishing a support line that makes potentially buying it a limited risk. On page 10, I wanted to touch on that uranium uranium, which this is the Sprott Physical Uranium Trust in Canadian dollars. And what we have is a clear breakout to a higher high. The uranium continues to be one of the hottest areas in the market. And this really does look like it's going to gun for the $28 to $30 area on the upside. Be really interesting to see whether that bullish leadership within the commodity basket continues here in the uranium. And the last chart I have on page 11 is copper. And I know that Oli was talking about copper and just how it is being currently priced. I still, though, think that this chart continues to demonstrate incredibly weak price action, making it vulnerable for potentially still even a trip back down to 2022 lows. Obviously, the big picture, there is a great bullish opportunity. And so any breakdown down to those kind of levels, I would view as an opportunity to position long-term on the upside of copper. But right now in the short term, very weak price action, and the most immediate risk to the downside is still there.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.